Well, good afternoon, everyone, and welcome to today's webinar hosted by the Iowa SourceLink and the Department of Revenue. My name is Patrick Winsman. I'm Senior Program Manager at the Center for Business Growth and Innovation here at the University of Northern Iowa. We are happy to partner with Department of Revenue and IEDA and everyone to bring you these series of webinars. A couple quick housekeeping things, and then we will get started with Matt, because that's who you're here to see today. As you have questions, please enter those into the question and answers box that you can find on the top part of your screen. We will be trying to take questions on as best we can. There'll be a couple breaks, so we'll try to answer those questions. If we can't get to your question during the live portion of today's webinar, we will be posting those when Matt and the team at the Department of Revenue have a chance to go and get you more specific answers to your questions. The slides, I posted the link in the chat, and I will do so again right after I go off video. You can get those either from the direct link, and I'll post the link to find them on Iowa SourceLink. So with that, we're happy to have everybody here today, and I'd like to introduce you to Matt Bishop. He is an attorney with the Department of Revenue, been there for about 3 years, and today he is going to talk us through the Iowa capital gain deduction and Iowa 100 form series. Matt, take it away.
All right, thank you, Patrick. As Patrick said, my name is Matt Bishop. I'm an attorney with the Department of Revenue for about the past 3 years. I work closely with a lot of the capital gain deduction issues. I want to thank everybody for coming here. The capital gain deduction is a very complicated deduction. We recently introduced the new Iowa 100 form series, which has generated a lot of discussion and a lot of questions. So I'm very happy to have this opportunity to share with you a lot of information about the capital gain deduction and a lot of the department's thought process behind the deduction in the new Iowa 100 form series. So let's go ahead and take a look at the slides. Okay, thank you, Patrick. The Iowa capital gain deduction is a statutory deduction. It's contained in the Iowa Code at section 422.7, subsection 21. If you want to know more information about the capital gain deduction, you can see our rules at 40.38. Also, there are various federal statutes, rules, court cases that can apply to the deduction as well. There are several cases and policy letters in our Iowa Tax Research Library that you can access on our website. We offer some capital gain flowcharts that can help explain the deduction. Those are also available on our department website. And most of all, there's the Iowa 100 form series, which does a great job of explaining the deduction. All of that is available on the department website, tax.iowa.gov. So briefly, what is the capital gain deduction? The capital gain deduction allows an individual who realizes a long-term capital gain for federal purposes to deduct the entire capital gain if they meet certain conditions. Those conditions usually involve holding the property for a required period of time. Depending on the property, that's 1 to 10 years. And the individual usually must participate in the business for a certain amount of time. When we're talking about the sale of a business or the sale of real property used in a business, that means the person typically must participate in the business for 10 years prior to the sale. So briefly, just to make sure everybody's on the same page, what is a long-term capital gain? I took this from one of the IRS tax topics. Almost everything you own and use for personal or investment purposes is a capital asset. Examples include home, personal use items like household furnishings and stocks or bonds held as investments. When you sell a capital asset, the difference between the basis in the asset and the amount you sell it for is a capital gain or a capital loss. Generally, an asset's basis is its cost to the owner. So what's a long-term capital gain? A long-term capital gain for federal purposes means an asset was held more than 12 months. If it's held 12 months or less, that's a short-term capital gain. Any short-term capital gain will not qualify for the Iowa capital gain deduction. And here it's important to note that held does not mean the same thing as owned. A holding period can be longer than the ownership period. For example, for gifted or inherited property, current owner's holding period may include the time the property was held by the previous owner. There are 6 categories of things that can qualify for the Iowa capital gain deduction. We have real property used in a business, cattle and horses, other breeding livestock, timber, and the gain from the sale of stock in an Iowa corporation to an Iowa employee stock ownership plan or an ESOP. Usually, to qualify for the Iowa capital gain deduction, the taxpayer must prove they're eligible for the deduction. Usually we want to see concurrent documentation, which means ideally we want the taxpayer to keep some sort of record of what they're doing while they're doing it. Providing us with records that are prepared after the fact aren't as helpful to us. We like to see calendars, appointment books, things like that that are made while the taxpayer is actually performing the activities. This deduction is available for individual income tax only, which means it can only be claimed by individuals. So if the capital gain flows from an S Corp, LLC, estate, or trust to an individual, that capital gain can qualify for the capital gain deduction. But if it's a C corporation that's selling the property, that generally will not qualify for the capital gain deduction. And when we're talking about the capital gain deduction, either the taxpayer or the property can be located outside Iowa. So you could have an Iowa resident selling, say, Nebraska farmland, or you could have a Nebraska resident selling Iowa farmland. Either of those situations could qualify for the capital gain deduction. Let me give you some statistics behind the capital gain deduction. This is a rough count of the number of returns that we've seen that have claimed the capital gain deduction over the years. So you see from 2004 to 2008, it was maybe about 14,000 returns claimed the deduction. After 2008, we really stepped up our education efforts, and I think that helped inform people of what did and did not qualify for the deduction. So we saw fewer claims. So from about 2009 to 2014, we saw about 10,000 returns annually that claimed the deduction. And then 2015 was the first year of the Iowa 100 series. And you can see that the number of claims dropped from about 10,000 returns to 6,600 returns. The next slide shows the amount of capital gain deduction that's claimed. So I just want to draw your attention most of all to 2014 to 2015. Even though the number of returns claiming the deduction fell from about 10,000 to 6,600 between those 2 years, the total amount of the deduction actually rose a little bit from about 400 million to 420 million. So even though the number of returns claiming the deduction has fallen a little bit over the past couple of years, over the past year, the dollar amount claimed has actually risen a little bit. And I think this slide really shows why we designed the Iowa 100 series. In 2014, before undertaking the Iowa 100 project, we had an intern who went through all 10,000 returns that claimed the capital gain deduction in 2013 and 2014. And he tried to categorize every deduction as a business, as the sale of a business, sale of a farm, sale of livestock, timber, or just unknown. And like I said, he reviewed about 10,000 returns, and about 2,000 of those returns, or about a fifth of those returns, he couldn't even tell from the returns what was being claimed. And that was a large problem for our exam purposes, where we would look at the returns to see what people are claiming, and we just, on a large number of them, we couldn't even answer the threshold question of what was even being claimed. And that meant a lot of correspondence with taxpayers to verify that they qualified for the capital gain deduction, and we're trying to eliminate some of that after the fact communication. So again, we had an intern go through the returns in 2015 to categorize what's being claimed. And now that we have the Iowa 100 series, we have a much better idea of what's actually being claimed. So you can see that the largest category is livestock. Most of the people who are claiming the capital gain deduction are doing it from the sale of livestock. Next is the sale of farmland, and then non-farm real estate, and then timber and business are pretty close, and then very few ESOP claims. What that means for dollar amount is, even though livestock claims were far and away the most common claims, the dollar amount was third place behind business real estate, or behind the sale of a business and the sale of farmland. And if I go back, you can see that the sale of business, we only had 373. So about 5% of the total claims were the sale of business, but the dollar amount for the sale of business was rather large. So the sale of business often means a rather large capital gain deduction. Now I want to talk about the Iowa 100 form series. The Iowa 100 form was required starting in tax year 2015. And like I said, our goal of the I-100 is to increase reporting of information when the taxpayers claim the deduction, so that the taxpayer won't need to provide additional information months or years after the sale when we examine the returns to make sure that the taxpayer actually qualified for the capital gain deduction. In 2015, the I-100 form was a long, complicated form. It was 6 pages long plus 6 pages of instruction. We received a lot of feedback from preparers and legislators, taxpayers, about problems with the I-100. And we formed a stakeholder group with a lot of those preparers to give us feedback on the I-100, to tell us what can be improved. So for tax year 2016, we've adopted a lot of the recommendations to address a lot of the concerns that the stakeholders, legislators, taxpayers, even software developers have told us about what we can do to improve the I-100 series. The goal of the I-100 in 2016 and beyond continues to be providing information upfront rather than years after the return is filed. In 2016, the I-100 will generally require less information than on the 2015 form. We're requesting less upfront information that taxpayers told us took a lot of effort to collect. We may still need this information for exam purposes if we do need to follow up for more information, but hopefully by lessening the burden for taxpayers when they file, compliance with the I-100 will be a lot easier for everybody. The biggest change for the I-100 for tax year 2016 is it's now a series of forms. So instead of one giant form, we now have 6 separate forms. Taxpayers select the form that applies to the type of property that they've sold. So we have a separate form for cattle, horses, and breeding livestock, for real property used in a farm business, for real property used in a non-farm business, for timber, for a business, and again for ESOP. So this allows us to focus on the specific property type that's sold. We could remove certain questions that weren't applicable to those property types, or we could reword other questions to really specify the type of information that we need. And then, like I said, the 2015 form was 6 pages long. The 2016 form is now going to be 1 to 3 pages. So it's going to be a much shorter form for pretty much everybody to look at. No more giant parts to skip around. Hopefully it will be a lot easier for everybody to complete. Brief word about installment sales. All payments from an installment sale may qualify for the capital gain deduction. Eligibility for the deduction is determined at the time of the sale. So for example, if you have a sale of farmland that's in installment payments, the sale takes place in 2010 and the installment payments take place through 2020. If the capital gain deduction qualifies in 2010, all of those future payments are going to qualify. So eligibility in the first year of an installment sale means eligibility in all subsequent years. We received a lot of feedback on installment sales for the I-100, that the I-100 was difficult for installment sales. We looked at these very closely, and we do believe that it's important for taxpayers to continue providing an I-100 every year of an installment sale. We have simplified the I-100 for all users, and we're hoping those changes will make a much easier form for taxpayers to complete for an installment sale. One change, for example, is that users of the I-100 don't need to report the total property sales price or the total property basis when reporting the gain from an installment sale. We're hoping that these changes make it much easier for taxpayers to complete the I-100 every year of an installment sale. I've got a question real quick. It's a little off.
It says, will a return be audited even if Form 100 has been completed correctly?
All right, thank you, Patrick. That is up to exam. I mean, when we see an I-100 form, without following up for more information, we can't really tell if it is completed correctly or not. Our exam program looks for certain things. If they do see something on an I-100 form that we need to follow up and it's been completed, hopefully it's just a quick check. Hey, we just need to verify this, or we just need one little bit of information. The I-100 is not going to audit-proof all claims, but hopefully it's going to reduce a lot of examination so that taxpayers will see a lot less correspondence after the fact. Now let's get into these specific forms. We're still finalizing these forms, but we're pretty sure this is what the forms are eventually going to look like. The first up is 100A, which is cattle, horses, and breeding livestock. The first question on every form is the gain reported under IRC section 1231? Basically asking, is this a long-term capital gain? And first question, yes or no. If that's a no, does not qualify for the capital gain deduction, you don't need to complete the rest of the form. You can't claim the deduction. If it's yes, you continue on to the rest of the page. Second, we get right into the table. If you remember this table from last year, it was a lot bigger. We asked for a lot more information. We've eliminated some of the questions. In particular, we don't ask for the date the livestock was acquired or the date the livestock was born. Instead, we just ask the taxpayer to affirm that the livestock meets the minimum holding period. And that's 24 months for cattle and horses, 12 months for other breeding livestock. You also see we only ask for purchaser name if the purchaser is a lineal descendant. So that's very few, that was honestly very few sales of livestock. So most sales of livestock, you don't need to provide purchaser names. All those sales at auction, you don't need to provide us with purchaser information anymore. Then we get into details of the property sold. Again, right away, we want to know, was this property sold by a C corporation? If it's sold by a C corporation, it's probably not going to qualify for the capital gain deduction. So we try to get that right up front. And we've also got a pre-instructions page where we point that out, that sales by a C corporation do not qualify for the capital gain deduction. So hopefully anybody who does have a capital gain from a C corporation will know that right up front, and they don't need to spend their time with the I-100 form to realize that, oh, this capital gain does not qualify for the deduction. Number two, we ask for the owner names, your co-owner names, and this is particular for the livestock form. We allow you to just report the pass-through entity that owned the livestock, because we found that a lot of livestock sales involve pass-through entities where there really wasn't a whole lot of participation in the pass-through entity, and it was a large burden for the taxpayer to get the names of those other members of the pass-through entity. So we're allowing taxpayers to just report the name of the pass-through entity who actually owned the livestock, if that's where it came from. And then if the taxpayer had a partial share of the livestock, enter the amount of their ownership. Then we ask for specific information for an installment sale. We need to know the start date, end date, and projected capital and the projected gain the taxpayer expects to receive during the installment sale. And then 4D, we ask for just the capital gain the taxpayer receives in 2016. We're not necessarily asking for the sales price and the basis. We're not asking for that math. We just need to know what's the capital gain that you're reporting in 2016. And then you follow that through to line 5, and that's going to be the amount that you report on your Iowa 1040, line 23. So hopefully this form has simplified things a lot for taxpayers who are selling livestock. And then the next slide, I apologize, I should have labeled this better. This is actually from the 2015 form. I just wanted to give everybody an idea of what it looked like before and some of the things that we've changed. You can see that we've rearranged a few bits of information and just hopefully making things a lot simpler for everybody. So the big takeaways from the sales of livestock is that horses and cattle, first of all, must be held for 24 months to qualify for the deduction, and they must be held for breeding, dairy, draft, or sporting purposes. So feeder animals won't necessarily qualify unless you're talking about, say, dairy cattle who might have been culled out. So they must be held for breeding, dairy, draft, or sporting purposes. If it's other livestock besides cattle and horses, they must be held for at least 12 months, and they must be held for breeding purposes. So say dairy goats would not qualify under this deduction. Must be held for breeding purposes if it's not cattle or horses. And other livestock means hogs, mules, donkeys, sheep, goat, fur-bearing mammals, other mammals. Other livestock does not include poultry, chickens, turkeys, pigeons, geese, birds, fish, frogs, reptiles. So that gives you an idea of the kind of animals that would qualify for the capital gain deduction. Next question, speaking of exams, does the department plan to send another wave of notices during tax season again this year? It is difficult to provide all information. We are busy with tax season. yes, we recognize that was a problem last year. We recognize that we had an exam program going on during tax season and also during the new I-100 form. So everybody was trying to learn the I-100 form while they were responding to exam inquiries. I think we spaced things out a little bit better. I mean, I know we've got some exam programs going on right now, but hopefully most of that information is going to be able to wait until after the filing season ends. But yes, we heard feedback of that, and we're cognizant of that. Next form in the series is the sale of real property used in a farm business. So the first question is we need to know the address or legal description of the farmland, because we know a lot of farmland isn't necessarily going to have a street address. Just give us the legal description, and we leave a lot of space for you to do that. We need to know the total number of acres sold. We need to know date acquired, date sold, and then the length of your holding period. And in certain situations, your holding period can be different than the ownership period. So question 5 allows you to explain why the holding period is different than the ownership period. Like you could have a like-kind exchange or an involuntary conversion, things like that could be the reason why holding period and ownership period would change. For real property used in a farm business, there are special provisions for taxpayers who are receiving old age Social Security benefits, disabled farmers, surviving spouses. So this next series of questions is trying to get at that and find out if the taxpayer qualifies for any of these special provisions. And then we have a table for the taxpayer to report on how they use the farmland over the relevant period, which is usually going to be the 10 years prior to the sale. So for each, well, on the final form, there will be 10 rows, and taxpayer will fill out 1 calendar year in each row. So for a sale in 2016, you start with calendar year 2015. If there's a land manager, provide us the name of the land manager and whether or not that manager was paid. Explain to us where the taxpayer reported farm income on their IRS forms, and then just explain to us where the number of acres that were put into each farm use. So we need to know the number of acres that the taxpayer personally farmed, the number of cash rent acres, the number of crop share acres, the number of CRP acres, and then whatever other acres that might be on the farmland. And on the previous page, you reported the number of acres sold. So in the number of boxes that explain how the acres were used, those acres should all add up to the total number of acres sold. And then we provide a question for the taxpayer to explain what they did on a daily, weekly, monthly, annual basis on the farmland. For most farmers, that's just going to be, I grew corn and beans, or I raised livestock. But for more specialized situations where maybe the taxpayer wasn't personally farming, that's the space for taxpayer to explain what they actually did. And then we ask for more information. Again, whether or not the property was owned by C Corporation. We need to know the names of all co-owners. So not just the pass-through entity. When we're selling real estate, we need to know the names of all other co-owners. We need to know if it was a co-owner situation, the percent that the taxpayer owned. We need to know how the taxpayer acquired the property. We need to know who purchased the property. And we need to know if it was an installment sale. Again, start date, end date of the installment sale, total gain projected. And then we need to know the capital gain received by the taxpayer in 2016. And then the final question of the form is just, what's your capital gain for 2016? We have a couple questions. Is there a threshold for the requirement of completing Form 100, or must Form 100 be completed for any amount of capital gain? It is any amount of capital gain. We understand that for livestock sales, that could be a small capital gain. Like I said, we've simplified the capital gain deduction form for livestock sales especially, so hopefully it's a lot easier for taxpayers to comply with that. For installment sales, again, we recognize that the actual installment received in any particular year can be small. So our advice is to hold on to the I-100 each year, and then you can use the information that you filled out in year 1 of the installment sale to fill out the future forms. So hopefully that lessens the burden a little bit. Second question.
So let's go. Yeah, I wanted to chat.
Oh, okay.
Let's do that one, and we'll maybe pass on some of these, just for timing's sake.
Okay. Is there a reason the 100B does not have the initial 1231 question the I-100 had? I might have missed that question. I might have missed that question when I was copying these. Yeah, that would be something that we would definitely want to have in the final form. Yeah, like I said, the IRC 1231 question is just asking, is this a long-term capital gain? And that's very important. It has to be a long-term capital gain.
Any of those you want to tackle real quick? Maybe dairy cows?
We can talk, question for dairy farmers killing cows, does each single cow need to be reported separately? As long as they all qualify, you should be able to group them in by sales. So if you're culling out, I don't know, 100 head of dairy cattle, you can just report that as culled out 100 headed cattle, and here's when we sold them, and here's our gain from that. So there is some grouping for livestock sales. Once you see the final form, the instructions will provide a lot more information for what can be grouped and how to be grouped. But yes, there'll be some grouping involved.
Question 14, there are only 4 rows to report on. Do we need to report all 10 years or just the previous 4 years?
Let's go back. Yes, so for space purposes, I cut this down to just 4 rows. In the final form, there will be 10 rows. So yes, there'll be space for taxpayer to report all 10 years. Yeah, in the interest of time, I think we need to keep going. So if you have additional questions, you can share them with us after the presentation. So some of the takeaways from sales of farmland, if you have a cash rent farm landlord, that's generally not going to be a material participant. So a cash rent farm landlord usually is not going to qualify for the capital gain deduction. Crop share farm landlord can be a material participant. The crop share farm landlord needs to participate in the farm operation, and a crop share landlord usually has to pay self-employment tax on the crop share income. That's not an always situation, but usually most crop share landlords need to pay self-employment tax on the crop share income, and the taxpayer must prove that a crop share arrangement existed. So we look for like crop share contracts or some sort of sales records to show that this was a crop share arrangement. CRP income is considered income from farm operations. A CRP manager can qualify for the capital gain deduction if they're participating in the CRP. Taxpayer participates in CRP by seeding, mowing, planting, or overseeing these activities. And just as a note, CRP income is usually subject to self-employment tax. Again, that's not an always situation, but that's something we'll look for. The next form is the 100C, which is the sale of real property used in a non-farm business. Again, we need to know the name of the business, and we need to know what the business did. So if you have a retail store, the business was in retail, or if you have an engineering firm, it was in engineering. So that's the kind of thing that we're looking for there. We need to know what kind of organization owned the land. We need to know where this real estate was located, so either an address or a legal description if there really is no street address. We need to know the ownership period, the holding period, then an explanation for why the holding period is different from ownership period if applicable. Again, we have the question about the C corporation. We need to know all co-owners, so not just the pass-through entity. Again, we need to know all co-owners. Again, ownership percentage, how the taxpayer acquired the property, purchaser name. Then we have, again, the information about installment sales. Then the next part of this form asks about the taxpayer's participation in the business. As I said earlier, for the sale of real property used in a business, there is a 10-year material participation requirement. The taxpayer must materially participate in the business for 10 years prior to the sale. So question 1 asks how the business used the property. So in the case of a retail store, you would say this is the location of the retail store. For an engineering firm, this is where our engineering offices were. For question 2, that gets into the tests for material participation. There are 7 tests for material participation, and this year we're asking taxpayers to just check which test they qualify for. And I will come back to these tests in just a minute, so just hold on to those. And then we have a question asking in detail what the taxpayer did on a daily, weekly, monthly, annual basis in the business. Provide as much specificity as you can. This is probably one of the big areas that we look at in exam to see exactly what the taxpayer was doing in the business. So just saying I participated in a continuous, substantial basis, that's not the kind of information we're looking for. We're looking for specific details. I was at my retail store every day, managing the store. That's the kind of granular detail that we're looking for. And then question 4 just asks for the total capital gain that the taxpayer is reporting, and then report that on the 1040 line 23. So some of the takeaways from material participation: both spouses' activities in the business count towards material participation. So husband and wife, both of their activities count, but the activities of other persons are not attributed to the taxpayer. So like employees, contractors, those people would not be attributed towards the taxpayer. Investor type activities do not count towards material participation. So things like bookkeeping and bill paying, that's not the kind of activities we're looking for in material participation. And if in a situation where the holding period is longer than the ownership period, such as like-kind exchange or an involuntary conversion, we'll read material participation back to the property that was actually relinquished. So if a taxpayer trades one piece of farmland for another piece of farmland, the material participation inquiry will go back to both pieces of farmland to try to figure out whether the taxpayer materially participated for the 10 years. So like I said, we have, well, let's get into questions before we get into the material participation.
So let's go here first.
Yes, so the question is, land sold from another state, active farming, and they are an Iowa resident, they would qualify for the Iowa capital gain deduction. Yes, that is correct. I mean, you could have material participation issues if, for say, a farmer and the farmland is located in an opposite state, but I mean, that could certainly happen. Yeah, that would definitely qualify. Is there any other questions we want to hit? I see, does a separate I-100 have to be filed for each spouse if married filing separate? Yes, if it's married filing separate, and each spouse is claiming the capital gain deduction, yes, they will need to file the I-100 for each spouse. Our question, are we responsible to know each individual asset sold through a pass-through entity if we know the owner held the business for over 10 years? That's a business question. We'll get back to that. I'll come back to that when we get to that. Just in the interest of moving on, let's get into the specific tests for material participation. The first test is a 500-hour test. The taxpayer participated in the business more than 500 hours in the tax year. That equals less than 10 hours per week. So an example of that would be the taxpayer's main business. So a lot of times if a farmer is farming farmland, that's going to be their main business. Everybody knows that farmer puts in much more than 500 hours a year. So that would be the test that a farmer would claim. And for proof of that, we just look for income, making sure that taxpayer is reporting income. That would make sense with working over 500 hours on this piece of property. Okay, slide 2, or test number 2 is substantially all participation. This test means the taxpayer's participation is substantially all participation of all persons in the business. So if anybody else is participating in the business, that's probably not going to qualify. So an example of that might be the taxpayer owns a very small business and the taxpayer has no employees. So that's the kind of thing we're looking for to satisfy test 2. Test 3 is more than 100 hours and no one participates more. This one can get kind of complicated. For this test, we consider the participation of all employees, contractors, anybody else who might have participated in the business. And to claim this, satisfy this test, the taxpayer must show their participation, and they must show the participation of all other persons. So they must show, first of all, that they participated in the business more than 100 hours, and they must show that nobody else participated more than the taxpayer. And as with all income tax deductions, all doubts are resolved in favor of taxation. So if a taxpayer is going to rely on this test, it's very important that they keep very good records to show who was participating in the business and how much they were doing it. So an example of this test would be a taxpayer with a small business with few employees. So maybe it's just a store that's open on weekends. The taxpayer is just there on weekends, and maybe they've got somebody to come in and help out. That's the kind of thing that we're looking for there. Test 4 is aggregate participation. This is a very difficult test to meet, but it's out there, so I want to make sure everybody's aware of it. The taxpayer participates in multiple businesses, excluding rentals, so rentals wouldn't count under this, for more than 100 hours in the year, and the total participation is more than 500 hours in the year. And every business that would be used in this test cannot qualify or cannot satisfy any other test. So that means that if a taxpayer has their main business that they're participating in 2,000 hours a year, and then they've also got a side business, maybe a restaurant, they spend 150 hours a year, that would not qualify under this test because you could not aggregate the 2,000-hour business with the 150-hour business. So an example of this is multiple businesses, and taxpayer participates in each business for 101 hours to 500 hours during the year. So maybe taxpayer owns 5 retail stores, and they spend 1 week a month in each store. That's the kind of thing that would qualify under this test. Test 5 is 5 of the prior 10 years. So to satisfy this test, a taxpayer satisfies any of the first 4 tests for 5 of the prior 10 years. And then the taxpayer has to satisfy this test for each year claimed. So this test arises in retirement situations where a taxpayer might retire in 2012, and then in 2014 they actually sell the business. There the taxpayer could rely on this test to say, I participated in the business for 5 of the past 10 years, for more than 5 of the past 10 years in that situation. So that would qualify as material participation under this test. Test number 6 is a material participant for life. This is a very specialized test for very specialized fields. A taxpayer who material participates in a personal service activity for any 3 years is a material participant in life, or for life. So these 3 years don't even have to be consecutive, just can be any 3 years, and it only needs to be 3 years. A personal service activity means health, law, engineering, architecture, accounting, or any business in which capital is not a material income producing factor. So examples of this would be accountants, doctors, lawyers who own their practice. Maybe they retire and don't actually sell the practice for 10, 20 years after retirement. In that situation, the accountant, doctor, lawyer, etc., would still qualify for the capital gain deduction because they could rely on this test as a material participant for life. Then test 7 is all facts and circumstances. This is kind of a catch-all test, and it's difficult to satisfy, so I want to talk about it a little bit. To satisfy this test, the taxpayer participates in the business for more than 100 hours in the year, and based on all facts and circumstances, the participation was regular, continuous, and substantial. So an example of this would be a taxpayer who owns a business and is uniquely essential to its success, but the taxpayer does not qualify under any other test. So this isn't just taxpayer participated for more than 100 hours, and the facts show that it would be fair. It needs to be a very high standard of, this taxpayer is uniquely qualified to run this business or to be in this business. This business quite literally could not have succeeded without this taxpayer's participation and only this taxpayer's participation. This is based on a federal standard, and there's only one federal case that I even know of that successfully claimed this deduction. I've got the case down below. The key quote from this case is, taxpayers' businesses are complex businesses that Mr. Wade was the taxpayer, built from the ground up and in which he continued to play a vital role. He was not merely a detached investor. Mr. Wade brought something to the businesses that no one else could have, and they could not have continued to operate without his contacts and expertise. I think in this case, the taxpayer started a chemical business. The taxpayer literally invented the chemical process that they used. He continued to consult with the business. He continued to maintain their client list. The court said, this business literally would have failed without the taxpayer's participation. So this taxpayer qualifies under Test 7. That's the kind of standard that we're looking for to qualify under Test 7. So I think we have a bunch of questions after running through all those tests. We have a question pretty specifically asking about a medical practice. I don't want to get into specifics here. That would be a good question to send us after the presentation. Oh.
So we've got a lot of great questions here.
Yes.
I think in terms of time, what we'll do, continue to put your questions into the question and answers box. We will have Matt continue to work through the last 3 remaining
Yes.
form series, and then we will stick around after the conclusion of the presentation, trying to answer as many of your questions that we are possible. And if it's not possible to answer those questions, we will follow up with a Q&A document that will have a long form text answer to those questions.
Yes, thank you. Yes, thank you, Patrick. So we're almost through the first 3 forms. The next 3 forms should go quicker. So hopefully we'll leave 5-10 minutes at the end for questions. And we clicked away again. Thank you. Okay, next form is timber. This one's fairly simple. We need to know the address of the timber, or like I said, location, legal description of the timber. Just need to know where it's located. Ownership period. Question 4 is explain how the purchaser intends to use the timber. This is a requirement under the federal form. So timber, it doesn't just mean selling trees. It means that the trees sold have to actually be used as timber. So we need to know exactly how the purchaser is intending to use the timber to verify that, yes, it was timber under the federal standards. And then question 5, was the gain from the sale of timber reported under 1231, asking, was this a long-term capital gain? Then these questions should be looking familiar. Was the timber owned by C Corp? Other owners, and again, you can report the pass-through entity on timber. Taxpayer's ownership share, how the taxpayer acquired it, purchaser name, details from an installment sale, and then the total capital gain deduction claim for the tax year. Some of the takeaways for timber is it must be treated as a sale or exchange of timber for federal purposes, which may mean the taxpayer-owned cut timber, standing timber, or a contract to cut standing timber. And timber means cut or standing trees usable for lumber, ornamentation, or other wood products. So that's the kind of timber sales that we're looking for. Form 100E is the sale of a business. We need to know the business name, the business address, what the business did, the activity of the business, the business organization type. The sale of capital stock or an ownership interest in a business generally will not qualify for the capital gain deduction. So question 5 is making sure that that's not the sale of capital stock or an ownership interest. Under certain situations, under certain federal liquidations, those ownership interest sales can be treated as a sale or acquisition of assets for federal income tax purposes. So question 6 asks, if this was a sale of capital stock or an ownership interest, does it meet one of these federal standards? And if it does not meet one of those standards, then the sale does not qualify for the capital gain deduction. Then we ask for ownership period and explanation of why holding period differs from the ownership period, if that applies. Description of all tangible personal property and service of the business sold. Provide as much detail as reasonable. You know, we don't need to know when we sold 5 chairs, 10 tables, things like that. But just a good description to give us an idea of what exactly was being sold. Just give us an idea of, you know, the tangible personal property, the specific items that were being sold, and what kind of service was being sold. Service means intangible assets too, so that can mean things like goodwill, client lists, things like that. That's the kind of things that we want to see for question 10. Then we need to know the fair market value of the tangible personal property and service of the business that was sold. Again, service of the business includes tangible assets. The total fair market value of all tangible personal property and service of the business, and then the share of the business sold, which means you know, the total assets sold divided by all assets of the business. And then we want to make sure that that's at least 90%, because the sale of business means at least 90% of these assets of the business. So then details of the property sold. Again, this should be looking familiar. Was it owned by C Corporation? All other owner names, ownership percentage, how the taxpayer acquired the property. We want to know the purchaser's name, and if there's a relation, we want to know the purchaser's relation to the taxpayer. And we need to know installment information if applicable. And then again, we have questions about material participation. First question is, was this a sale of business to a lineal descendant? Because the sale of a business to a lineal descendant does not need to have material participation. So if it's a sale to a lineal descendant, you can skip the material participation questions. If it was not a sale to a lineal descendant, you continue on to answer these same material participation questions from the sale of real estate. And then question 3 is for the taxpayer to describe their daily, weekly, monthly, annual duties in the business. So again, provide us with as much detail as possible. You know, I was at the retail store every day, or this is my engineering firm. I was at the engineering firm every day. That's the kind, you know, we want granular detail, as much information as you can provide us in this question. And then question 4 is for the taxpayer to report their capital gain deduction for the year. So the takeaways from this form are that the deduction is tied to the sale of a business and not just the sale of business assets. A business must actually be sold. If a taxpayer is just selling off a few business assets, that's not going to be the sale of a business. Must actually be the sale of a business. And again, the sale of a business means you've got some organized entity and you're selling at least 90% of the fair market value of the tangible personal property and service of the business. Service of the business, again, that includes intangibles, which means goodwill, going concern value, patents, client lists, trademarks. Service of the business does not include cash receivables, cash, and inventory. And again, the sale of part of a business generally does not qualify for the deduction. So an example of that would be a taxpayer has a lawn care business that also does snow removal, and the taxpayer just sells off the snow removal part of the business. That's probably not going to qualify for the capital gain deduction unless that snow removal part was a really small part, you know, less than 10% of the total business. The final form is ESOP, the sale of employer securities to a qualified Iowa employee stock ownership plan. We haven't seen a lot of these claims, but we want people to be aware of that. So we need to know the name of the Iowa corporation, and we need to know that the ESOP owns at least 30% of all outstanding employer securities issued by the Iowa corporation after the sale. And then again, we need to know details of the property sold, whether it was owned by a C Corp, the owner's name, the ownership percentage, purchaser's name, installment sale information if that applies. And then this form is a little different in that it asks for the total capital gain claim for the tax year, and then you need to have that. So it's half the capital gain from this ESOP sale qualifies for the capital gain deduction. And then the takeaways from this are, again, it's a 50% deduction only. There are no holding or material participation requirements for the ESOP deduction, so this one is unique in that respect. The security sold must be from an Iowa corporation, so if it's a corporation not based in Iowa, then that's not going to qualify. And the ESOP must be established by an Iowa corporation for the benefit of the employees of that corporation. I think the last few slides are just wrapping up. Let's get into some of these questions before we get into the final slides.
Okay. So, you just want to go back up to the top.
Sure.
Now?
Sure. We'll get to as many of these questions as we can. What is the importance of acres owned and acres rented? You know, we need to know. We need to verify the property sold, so that's why we need to know the acres owned, and then we need to know how the taxpayer used the property. And like I said, acres rented, depending on whether that was a crop share arrangement or a cash rent arrangement, that may or may not qualify for the capital gain deduction. So that's why we ask for the breakdown of how the acres were used, and we would look for some sort of apportionment if the entire property was not used for a qualifying material participation purpose. So that's why we're asking for the breakdown of acres, how the acres are used. Next question is, if property was used in part in a farm business and part in a non-business, how do we report this type of sale? Again, that's probably why we were asking for the breakdown of the number of acres. So, gosh, I'm trying to think of an example. So if you've got a 100-acre plot of land, 90 of those acres are farm acres, and 10% of and 10 of those acres are, let's say, a hunting preserve, you would report that on that table that we broke it down. You would report that as 90 acres of personal farm and then 10 acres of other. And then again, we'd have some sort of apportionment going on. So you would break it down when you actually claim the capital gain deduction. Question, can you give a scenario where farm ground that is being rented, the land is sold, would qualify for capital gain deduction? So an example of farmland that's being rented that would qualify for the capital gain deduction is probably going to be a crop share arrangement. So again, we would look for documentation. We would look for rental agreements. Sales agreements would be helpful to show that the taxpayer was the one who was actually selling the crops that were being raised. For a cash rent arrangement, that's going to be very difficult to qualify for the capital gain deduction. Boy, we would need, as I was saying earlier, we would need calendar books, appointment books. We would need the taxpayer to keep very detailed records to show that they were very involved in this cash rent operation, that they were frequently consulting with the tenant, maybe supplying seed and equipment to the tenant, just showing a lot of involvement in a cash rent scenario. And again, for a cash rent scenario, that would probably need to satisfy the 500 hours test. Because for a cash rent scenario, of course, the tenant's going to be participating in the farm business a lot more than the cash rent farmland would. Cash rent farm landlord would participate. So again, a cash rent farm situation is going to be very difficult to qualify for the capital gain deduction. Next question.
We looked at that one already.
Okay.
So that one we're gonna get back to, right?
Which one? Well, I guess the next question, are we responsible to know each individual asset sold within a pass-through entity if we know the owner held the business for over 10 years? Again, that goes back to the sale of a business. We need to know what was sold. So, I mean, we're not going to need to know granular detail of, every single table and chair that was being sold, but we're going to need to know a good idea of the tangible personal property and the service of the business that was actually being sold. So in a pass-through entity, we recognize that in a pass-through entity, there can be issues of getting that information. But I mean, that's information that we really need to know. And in a situation where the taxpayer is materially participating in the business, that should be something where the taxpayer should be able to get that information. Next question, would rental property qualify as real property used in a non-farm business? That could, but the taxpayer is going to need to materially participate in that rental, which is a difficult thing to do. Most rental landlords do not have material participation. So if taxpayer believes that they're materially participating in renting commercial real estate or residential real estate, taxpayer is going to need to show us that they were very involved in renting that they were out there, that the taxpayer was the one who was personally performing repairs, that the taxpayer was the one out there, mowing the lawn, clearing snow, things like that. It's difficult for a rental landlord to qualify for the capital gain deduction. I'm going to move along. For farmers who retired then rent the land out for some years afterwards, do they meet the material participation? For retired farmers, there can be two provisions. There's the 5 of the past 10 years test. So if the farmer sold the land 5 years after retiring or less than that, then that farmer would still qualify for the capital gain deduction. Otherwise, there is the special provision for farmers who are receiving Social Security. That test is the farmer was materially participating in the farm business for 5 of the 8 years before the taxpayer began receiving Social Security benefits. So if a farmer retires in 2010, the farmer starts drawing old age Social Security benefits in 2011, then that farmer is going to qualify for the capital gain deduction for life. So in that situation, if the farmer winds up selling the farmland in 2040, that sale is still going to qualify for the capital gain deduction, assuming the deduction doesn't change before that. Next question, if a retired farmer puts land into trust, does that create a new holding period? If not, does it affect their material participation? Boy, that's going to be a real fact-specific question. We need to know the details of the trust and how all that works. I don't really feel comfortable answering that right here. Next question, how do you show material participation when land is purchased? I guess I'm not sure what that question is asking. Again, for material participation, we're looking for things like calendars, appointment books, any sort of financial records, anything to show that the taxpayer was actually participating in whatever business owned the land. Next question, if taxpayer owns a rental house and hires a management company to handle their rent collection repairs, can they still qualify as material participating? That's going to be extremely difficult. Whether there was a management company involved is one of the things we're looking for. If there was a management company involved, boy, we would need to show an awful lot of participation by that taxpayer. And I quite frankly, I'm not sure that's possible. Maybe if we're talking about a very large piece of rental property and the taxpayer was a live-in caretaker for that property, maybe a situation like that can qualify. But boy, if there's a management company, that's going to be very hard for a taxpayer to qualify for the capital gain deduction. If a farmer sells some of his land, does it still qualify as a capital gain deduction if he is not selling all of his land and he continues to farm? Yes, that would qualify. So that would involve some sort of partition for the land. So we would just need to know the details for the land sold. And yeah, that would just be treated as just a normal sale. Let's get specific. Farm ground has been crop shared for 20 years. Is that eligible for the capital gain deduction or only for the co-owner that has been taking care of it? The owner of a farm crop share landlord can qualify for the capital gain deduction if that landlord is participating in the crop share arrangement. So yes, we would need to verify that the crop share landlord was actively involved in the crop share arrangement somehow, overseeing the farm operations. If you have say an out-of-state co-owner who's just not involved in the crop share arrangement, that's probably not going to qualify as material participation. Mentioned milking goats would not qualify for the Iowa capital gain deduction. However, these goats also breed and add to the herd. Again, if that's breeding livestock, that would qualify for the capital gain deduction, and that's federal standard as far as what qualifies as breeding livestock. So we would defer to whatever the IRS would say on that. So yeah, if you've got a dual-purpose livestock, it's like a goat who's partly used for breeding, partly used for dairy purposes, we would defer to whatever the IRS says as far as whether or not those are breeding livestock. Farmer selling raised breeding livestock, it does qualify. Again, assuming the holding period is satisfied, yes, that would qualify. But if a farmer happens to sell a piece of business equipment that has a portion of capital gain in the sale, that capital gain does not qualify for the deduction. That's correct. I mean, that involves two separate deductions. So you've got the sale of breeding livestock, that's you'd fill out the 100A for the sale of breeding livestock. And then the sale of business equipment, that's going to have to fit under the sale of business. So if a farmer is just selling off his combine, that's probably not going to qualify as the sale of business. So if a farmer is just selling off one piece of business equipment and the farmer is holding on to other pieces of equipment, that's probably not going to qualify for the capital gain deduction. But if a farmer is retiring and having a big equipment sale and the farmer sells off all the equipment, that would qualify as the sale of a business. And any capital gain from that would qualify for the capital gain deduction. Assuming that the equipment sold is at least 90% of all the farm tangible personal property and service.
So we are coming right up on 1 o'clock.
Okay.
So we are going to let Matt finish up his last couple slides, and if there are a few other questions we can get to, stick around for those. Otherwise, thank you everybody for participating in this webinar with us today. Matt, I'll turn it back over to you to wrap up these last couple slides.
Okay, great. Just want to go through some of our general resource slides. All of our tax forms are available online. Again, our website is tax.iowa.gov. So you look for forms right from the main page, and then we have a separate section for individual income tax forms. We have our Iowa Tax Research Library. Again, you can find that from our main website, that's tax.iowa.gov. That has a lot of our decisions, a lot of our informal guidance, a lot of our formal guidance, so you can find answers to specific questions on our Tax Research Library. Again, our website, tax.iowa.gov. You can subscribe to email updates at the circled link there. Then we will go ahead and email you regular updates on any changes or any big news that's happening in the tax world. You can subscribe to just general news, tax information, e-file and pay information. You can sign up for due date reminders, which is very helpful for anybody who has to file regularly. You can sign up for economic, fiscal, and statistical information and for electronic filing. And these are replacing our former e-lists. We have Twitter accounts. We'd love to have more Twitter followers. We have tweets directed at business tax, income tax, and tax pros. We'd love to have everybody follow us there. Like us on Facebook. We always need more friends. We would love to have all you as friends. This is our general disclaimer. This is for general educational purposes only. If you're involved in an audit or protest, please contact the representative that you're working with on that issue, and they will be able to help you. Questions, we've already run through a bunch of questions. I wish I could stay, but we need to wrap up. I thank everybody for the opportunity to talk to you about this. If you have any additional feedback on the Iowa 100 series, this is an ongoing process. We plan on revising and improving it in years to come, so please send us any feedback you have on the forum. We'd love to hear it.
Awesome. Well, thank you, Matt, very much for coming and presenting with us today. For those of you that have submitted questions that we haven't got to yet, we will be following up with a Q&A document in the next couple of weeks once Matt and the team have a chance to go through and answer those questions in general. This presentation has been recorded and will be archived up on Iowa SourceLink, where you'll be able to go back and watch it there as well. We are having one last Department of Revenue webinar series in December. You can sign up for that on iowasourcelink.com. And that is on electronic submission of W-2s and 1099s. So with that, thank you again, everybody, for coming. We always appreciate you coming in and spending an hour with us to learn about what the Iowa Department of Revenue has to share. So with that, there's hopefully we answered a couple more questions. One more. Matt, is there a specific email address that they can send a specific question? Is that the idr@iowa.gov? Is that the best way?
Yeah, that's probably the best way. The best way to address questions is to send them to our general email address. Then we can direct it from there to whoever would have the most expertise in answering the questions.
Awesome. Well, with that, look forward to hopefully seeing you back here in another webinar. Please reach out if you have questions about the webinar process, and we will again be following up with both the archived webinar and the question and answer. So thanks everybody for coming today. Please enjoy the rest of your Wednesday.